Okay, the only two funds you need to be successful at wealth building. All right, we're going to get into this one, but before we do, I'd like to ask you to go ahead and hit that like button, subscribe to the channel, and hit that notification bell if you find my content valuable. All right, I'm going to show you my t-shirt here really quick. This is San Benito Greyhounds, all right? San Benito is the town that I actually work in. I'm going to talk about that a little bit, the Greyhounds a little bit as I talk about this particular video. But let's get into this one. The only two funds you need to build wealth. All right. Now, this is a very, very specific topic that I'm going to be talking about, or a very specific strategy. All right. And we'll be using a company called Vanguard. Now, total disclosure, I use Vanguard with my investing, okay? But I'm not a financial advisor. So you definitely want to do your own research. But what I hope that I'm able to do is to ignite your critical thinking and it cause you to engage with your critical thinking and get into the investment game. And I think that this two-fund approach is simple enough to get you to a point to where you actually can feel confidence about your investing. All right, let's jump right into it. The two funds are two Vanguard funds. One is the total stock market index fund, and the second fund is the total bond market index fund. Now, the ticker symbols through Vanguard for the total stock market index fund is VTSAX. That's the ticker symbol for the total stock market fund. Now, for the total bond market fund through Vanguard, the ticker symbol is VBTLX. Again, the ticker symbol is VBTLX. And these are going to be the two stock market index funds that we're going to be actually looking at, or the two index funds, rather, that we're going to be looking at. The total stock market fund and the total bond market fund through Vanguard. All right? And here is the simplicity of it. You utilize the total stock market fund as the foundation of your portfolio. So you don't have to be confused. You don't have to be overwhelmed with this topic of investing, because it is difficult. There's so many things coming at you when you look at how to invest, what to invest in. And unfortunately, you've got to take care of this. There are no more pensions and things like that. I've mentioned this in the past. So you have to take care of this. And it's kind of tough to do when you don't know anything. So again, the total stock market fund can be the foundation. And it's a highly diversified fund, okay? In fact, this fund has over 3,500 stocks within it. So you have a high amount of diversification within this fund. That's a very, very important thing, because you don't want to be counting on one stock or even a handful of stocks or even 100 stocks. Here you have 3,500 plus stocks that you're investing in within a whole pool or a whole bucket of this index fund. So it's highly diversified. So there's the total stock market index fund. Now, there's also the total bond market index fund, all right? Now, bonds are debt instruments, okay? There are government bonds. Government bonds are extremely safe because the government the US government has always paid its debts, at least so far. They've always paid their debts. So a total bond market fund will have things like US bonds in them, government bonds. It'll also have corporate bonds of very, very large and stable companies, those type of bonds, okay? So Vanguard has its total bond market fund, and check this out. The total bond market has over 11,400 different bonds, over 11,400 different bonds within Vanguard's total bond market fund, okay? Let's kind of switch back to the total stock market fund that has over 3,500 stocks within it. Well, it certainly has large companies in it. Companies like Apple, Microsoft, Google, okay, Facebook, all of these different types of companies, those large companies. It also has mid-sized companies and small companies that you may not have even heard of. But it's 3,500 plus companies. So you're highly diversified there, okay? So all you need to do is have that foundation, and you can have the confidence to actually get into the game and start investing. But I know that some people have some fear or trepidation about investing. When you look at the news, the stock market goes up and down. Yes, it does. It goes up and down. But if you zoom out and look over time, since the inception of the stock market, it has had a wonderful return, a return of in that 11% range. So it's really a good thing to invest in, but still, I understand the fear. I understand some of the trepidation of investing. And that's where bonds come in. Bonds help to smooth out that ride up and down, and it keeps you from jumping out or pulling your money out of the stock market when things get a little rough, when the waters get choppy. And that brings me back to what I was talking about my shirt, the San Benito Greyhounds. Now, I work at HEB in San Benito, and one of the neat things about working there at HEB in San Benito is that we have a lot of Greyhounds fans, people in the town that support the Greyhounds, and they wear their purple shirts just like I have on. They wear their hats and all of those different things. And I noticed that they're supporting the team when there is a game, and when the team wins a game, they may be wearing their stuff several days afterwards and that sort of thing. But I bet no matter what happens, like let's say several weeks down the line that the team loses a game, if I ask them, do you support the Greyhounds? Or I even ask them, are you a Greyhound? They'll be like, yes. They're positive about their team. They're still supporting the Greyhound team. Whether the team wins by many points or the team loses by many points, or they win by a few points or lose by a few points, they're supporting the team through ups and downs, okay? And that's kind of like you want to be in your investing. There's that term out there, that acronym is ABB, okay? ABB. And what ABB means is always be buying. Whether the stock market is up or the stock market is down, always be buying. And by sprinkling in some bonds sometimes, it gets you at that confidence level, since you're smoothing out the ride a little bit, to always be buying. Now there's a rule out there. It's called the 120 rule of thumb. And it's a way of looking at your allocation. How many stocks, or what percentage of stocks should you have, and what percentage of bonds? Well, this 120 rule of thumb kind of helps you conceptualize that and maybe have some confidence of knowing what allocation to have, what percentage to have. And how it goes is you take the number 120 and subtract your age, and that gives you how much stock you should have in your portfolio as opposed to bonds, or what ratio you should have. Okay, let's take a look at what this is, or how it looks, or how to implement it, okay? Let's say that you're 20 years old, okay? And you're looking at this 120 rule. Well, if you're 20 years old, you just take 120 and subtract 20 from that because you're 20 years old, and you end up with 100. So what this means is that 20 years old, by this rule of thumb, you should be 100% stocks. Or in this example that I've been given, you would be 100% VBTLX, or the total stock market fund with Vanguard. Now, why is this suggested? Well, because at 20 years old, you have a high, what they call risk tolerance, okay? If you're 20 years old and the normal retirement age is 65, what is that? This is public math. That's 45 years that you have until retirement. That is a long time. So you're okay. At 45 years, being total stocks, you've got a lot of time for the ride through that volatility of the stock market, okay? Let's take 40 years old with this 120 rule of thumb. So what you would do is take 120 minus 40 because you're at 40 years old. That leaves you with 80. So according to this rule, you would have 80% stocks and 20% bonds. So 80% total stock market Vanguard index fund, 20% total stock market Vanguard bond market, total bond market fund, okay? So that's where you would be at 40. Why? Because your risk tolerance goes down a little bit. Because you're 40 years old, so you have 25 years left till your retirement. So you add a few bonds, one to smooth out the ride, but also because you have less risk tolerance. If the stock market is down when you're at retirement, then you don't have as much time for it to recover, okay? So that's the rule of 120. And by sprinkling in those bonds can give you a little bit more confidence. Now I'm going to tell you a little bit about myself personally because I use that exact allocation in my 401k. I'm 80% total stock market within my 401k. I'm 20% total bond market in my 401k. Okay, so I have that 80-20 split. I'm 55 years old, but my risk tolerance is a little bit higher. I want to have more growth, okay? Now, you may be comfortable with something like that at my age, or you may not be. And that's why you want to engage your critical thinking. Look at this rule of thumb, have it as a rule of thumb for yourself, but do research and actually come up with what you're comfortable with as far as your strategy for retirement. Or I like to call it your opportunity and the options phase of your life, where you can choose to work part-time or not work at all when you reach age 65. All right, so we talked about these things a little bit. The 120 rule, sprinkling in those bonds to help you smooth out the ride of investing. The bottom line is that hopefully this gives you some confidence. There are those two funds from Vanguard, but you can purchase a total stock market fund and a total bond market fund at other companies. It's not all about Vanguard, or your 401k may not have Vanguard in it, but you can look and set up a total stock market for stocks and a total bond market fund for your bonds within your 401k, because they're going to offer those things within your 401k. So the whole point is to have a strategy that you feel good about, where you're able to do A, B, B. Always be buying, always be investing and building your future. Hopefully this one helps to engage your critical thinking, because you really only need 2 index funds to be successful at this investing game. So get in there, make it happen. Do not sit on the sidelines. Build your wealth so that you can retire with dignity. Again, if you find my content valuable, go ahead and hit that like button, subscribe to the channel, and hit that notification bell. Also, leave something in the comments. What do you think about this 2-fund portfolio? Is it something that you like? Is it something that you maybe have some critiques for or some criticisms? Go ahead and leave that in the comments. I think it is a great way to get you off the sidelines and to have a simple strategy that gets you in the game. Again, I'd like to thank you for listening.